Who really controls the money we use every day? Is it the government printing currency at will? Or is it the banks quietly creating money out of thin air through loans? Maybe it's neither, and something far bigger and hidden shapes our entire financial system. By the end, you'll see that what we thought was simple cash in our hands is actually part of a much deeper, complex system. Today we'll talk about who controls money: governments, banks, or someone else. So before we start, make sure to hit the like button and subscribe to my channel. 1. The mystery of money control. Who really controls money? The government, banks, or someone else entirely? At first glance, it seems simple. Governments print currency, set tax rules, and manage the economy. But in reality, money control is far more complex. While central banks and governments influence policy and currency supply, commercial banks play a huge role in creating money through loans. Private banks generate most of the money circulating in the economy, not the government. Beyond this, international institutions, investors, and global markets also influence monetary flows. Understanding who controls money requires looking beyond physical cash to the invisible systems of banking, lending, and policy. The answer is not straightforward. It's a network of institutions, trust, and rules, each shaping how money moves, who has access to it, and how wealth is distributed. 2. The role of governments. Governments are often seen as the ultimate authority over money. They issue legal tender, collect taxes, and regulate financial institutions. Central banks, like the Federal Reserve in the US or the State Bank of Pakistan, are government-aligned entities that manage currency, control interest rates, and ensure economic stability. Through fiscal policy, spending, and taxation, governments influence how money flows in the economy. Governments also set laws to prevent fraud, regulate banks, and protect citizens' savings. However, governments do not directly control the majority of money circulating in the economy. Most of it is created by commercial banks through lending. This reveals that while governments guide and influence the monetary system, they are not the sole controllers of money. They set the rules but do not execute day-to-day money creation. 3. Central banks and monetary policy. Central banks act as the guardians of a nation's money. They manage inflation, adjust interest rates, and control the supply of base money. By buying or selling government bonds and regulating reserve requirements, central banks influence lending and spending. They also act as lenders of last resort for commercial banks during crisis, maintaining financial stability. Central banks do not create all money directly. Their role is to oversee and regulate the system, ensuring smooth circulation. By controlling the cost of borrowing and the availability of funds, central banks wield enormous power over economic activity. However, their influence is largely indirect. They guide commercial banks, influence consumer behavior, and manage systemic risk rather than issuing every dollar or rupee used in daily life. 4. Commercial banks, the hidden creators. Commercial banks are the true engines behind money creation. Every time a bank issues a loan, it creates a deposit in the borrower's account. This means new money enters the economy without government printing. Mortgages, business loans, and personal loans all expand the money supply. Banks keep only a fraction of deposits in reserve, allowing them to lend multiple times over. This process, called fractional reserve banking, multiplies money far beyond physical cash. Banks profit from interest, and the system relies on continuous lending and economic growth. While governments and central banks influence rules, commercial banks decide how much money to create based on demand, risk, and profit. In this sense, commercial banks are arguably the most powerful controllers of day-to-day money flows, shaping economies without most people ever realizing it. 5. The power of credit. Money is not just physical notes and coins. It is largely credit. Credit allows banks to lend money that didn't exist before, instantly increasing purchasing power. When a loan is approved, the borrower can spend immediately, creating economic activity. Repaying loans destroys money in reverse, showing that the money supply constantly expands and contracts. Governments and central banks provide frameworks, but the power of money creation is exercised by banks issuing credit. This is why economies are growth-dependent. Total debt often exceeds existing money, requiring continuous expansion. 6. International influences. Money control is not confined to national borders. Global trade, foreign investment, and multinational corporations influence the value and flow of money. Exchange rates, capital markets, and international loans affect local economies, sometimes overpowering national monetary policies. International organizations, such as the IMF or World Bank, also play a role in shaping monetary decisions in developing countries. Even wealthy investors and hedge funds can influence interest rates, stock markets, and currency values. This means that control over money is partially globalized, not purely domestic. Citizens may assume their governments dictate all financial outcomes, but international financial flows, speculation, and agreements heavily impact how money moves and whose wealth grows. 7. The myth of cash control. Many people believe cash is the ultimate form of money, controlled entirely by governments. In reality, cash is a tiny fraction of total money supply. Digital deposits, bank credits, and electronic transactions dominate modern economies. While governments print currency, the bulk of money exists digitally, created through lending and banking operations. This makes money control less tangible than imagined. Digital banking allows instant creation and transfer of money, multiplying the influence of banks. Governments and central banks set regulations, but the majority of daily money movements are outside direct state control. 8. Who really has the power? So, who truly controls money? It is a layered system. Governments regulate and issue legal tender. Central banks guide monetary policy. Commercial banks create most money, and global markets influence flows. No single entity has absolute control. Commercial banks may appear to wield the most immediate power because they create money and influence economic activity daily. Governments and central banks provide the rules, oversight, and stability, but execution is decentralized. Citizens, consumers, and businesses also play a role, as spending, borrowing, and investing decisions impact the money supply. 9. Why understanding money control matters. Understanding who controls money is essential for financial literacy. Misconceptions about money often lead to poor decisions, such as over-reliance on cash savings, ignoring inflation, or misunderstanding debt. Realizing that banks create most money, the governments and central banks set rules, and that global forces impact domestic economies helps individuals plan better. Financial knowledge empowers people to invest wisely, borrow responsibly, and navigate economic changes. It also clarifies why some policies, like interest rate hikes or fiscal stimulus, affect daily life. 10. The takeaway. Money control is not as simple as it seems. It is a system of shared influence among governments, central banks, commercial banks, and global markets. Physical currency is just the tip of the iceberg. Most money exists digitally, created through lending and credit. While governments regulate and central banks guide, commercial banks execute day-to-day money creation. International forces also influence currency flows and financial stability. Understanding this complex system reveals who truly shapes the economy, how policies affect citizens, and why financial literacy is critical. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.